Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome. My name's Larry Flynn. I'm one of the advisors here at Centennial Wealth. Welcome to the second quarter 2020 quarterly market update. Today I'm going to share with you a number of fundamentals. There's a lot going on, a lot to share, so I'll get right on it. First of all, you can see the major indexes. S&P down 4.5% as the end of June, Dow down 10%, but look at the NASDAQ, up 12%. Just want to talk about that a little bit. Just look at this. You got Amazon, Microsoft, Apple, Google, Facebook, tremendous returns year to date. It stands to reason, right? During the pandemic, technology has been of huge demand and has done very, very well. But you look at, this is as of June 8th, but look at the S&P 500 index. Basically, as a whole, was at a break even though these technology stocks were way up. And then you look at the S&P 500. If you give equal weight to the S&P 500, I mean, you give every stock 0.2% weighing, it was actually, if you look across the board, it was down 2%. So you can see that technology stocks are, for all practical purposes, holding up the S&P 500. The market cap of the technology stocks here, just the last 6-7 years, is basically doubled. Those companies represented about 10% of the S&P 500. Now they represent about 20%. You can see here it's odd because if you look at the market cap of these technology stocks, it's almost 20% of the S&P 500. But if you look at the revenue of those same stocks, it's only 4%. So economically they're not a huge impact on the economy, but with the S&P 500 they have been. This is quite interesting. I just saw recently Tesla, of all things, surpassed all the other auto dealers, as far as market cap goes. But you look at this as Zoom, hardly any of us even heard about Zoom prior to the pandemic. And right now is bigger in market cap than the 7 largest airlines. Crazy. Hertz. This is a very interesting story. You've had a rise in these online tradings. Robinhood one that came out 5, 6, 7 years ago. Last year was about 10 million users. Now I think just surpassed 13 million users. You got a lot of people with time on their hands doing trading. But this one, just to tell you how euphoric things are out there. Hertz on February 21st was about $20 a share. On March 18th, as things started selling off, it dropped to $3 a share. And then on May 24th, it declares bankruptcy and goes down to 55 cents a share. Now, when it files bankruptcy, it's basically saying it doesn't have enough to pay its creditors. Okay, that's why they file bankruptcy. So on June 8th, look what it did. It went up. Who would want to buy a company that's barely able to pay its bondholders, its creditors? There's certainly not going to be anything left for equity holders or stockholders, and the stock is going up. It's crazy the kind of stuff that's happening out there. Now, as of June 30th, it was at $1.41, but again, why do I want to own a company that's going bankrupt? This is the S&P 500 just over the last year. You can see that big drop in March, and then it's been slowly coming back. It hasn't quite come back to where its high was, but I just want you to notice the last 1 month in this chart. It's pretty much been flat. It was on the rise for quite some time. Now, as of June, there's starting to be some resistance. This is just the S&P 500 versus the VEU, which is basically everybody else except us in the world. And you can see we're much more globally connected than people want to realize. You can see our market with the other world markets just basically been going in tandem. So when you hear things like global recession, know that's hitting our shores as well. GDP growth, you can see at that first quarter, the final estimate for first quarter was down 5%. And remember, most of that was just that last 2 weeks of the month. Now, the latest estimate I've seen for the second quarter is down 39%. folks, that's worse than what happened at the Great Depression, right? So we'll see where this goes. We're technically, when you have 2 quarters in a row of negative GDP growth, you're technically in a recession. I dare say that's going to be the case now. We can now call this a recession. What we want to find out is whether this is going to be a depression or not. Unemployment, historic lows pre-pandemic, and now it just shot right up there. You can see of recent there's just been a slight downtick. People are reacting favorably to this because they're seeing the unemployment go down, and they think we're rapidly approaching recovery. Folks, I'm not sure. The case is still out as to how many of these jobs or people that are on unemployment are still going to have jobs at the end of this. So we'll see. Inflation rate was kind of at the target rate for the Feds, which is right around 2% for the longest time, and now it's just dropped down to 0. Some expect, following this pandemic, that people are going to be much more cautious about their spending. So there's some fears, going forward that we might have more deflation than we do inflation for a period of time. On June 30th, Jerome Powell, the Fed chair, and Stephen Mnuchin, the Secretary of Treasury, testified before Congress as to where they were at with this with the recovery. And Powell said a full recovery is unlikely until people are confident that it's safe to re-engage in a broad range of activities. Well, if that doesn't say everything right there. That's really going to be the telltale, is how quickly people are going to feel confident enough to get out there. I've said this before, I'll say it again, and I think some of this is playing out already as things opened up. You're going to see 1/3 get out there right away, and you're going to see another 2/3 kind of lay back and see how the 1/3 does, and then you're going to have maybe another third feel like when the coast is clear, start venturing out. But I dare say you're going to have another 1/3 it's not going to get out there until they very much feel things are safe, or we have a treatment or a vaccine. And they're doing that for various reasons, because they might have some health issues, or they might be older. The Feds, unprecedented. They're now buying corporate bond ETFs and literally buying the corporate bonds themselves. Okay, I'll explain a little bit here why they're doing that, but right now to the tune of about $9 billion. And the kind of bonds they're buying are companies like this. Their top 10 holdings: Toyota, Apple, Verizon, Ford, Comcast. All right, it stands to reason why they might be buying the bonds of some of these car companies, right, with things the way they are. And then they're not going after junk bonds either. You can see that 42% is investment grade. You got another almost 55% in BBB rated bonds. Now, as a general rule, when you start to get below BBB, you're getting into junk bond territory. So, but you can see they're buying good companies. Why is that? Well, this is the reason. Downgrades have been on the rise for quite some time. This is where Standard & Poor's is rating a company as to their ability to pay their bills, their debts, and they get a great rating, A rating if they're real good, and maybe a B rating, and starts to go down as they don't. Well, companies, the downgrades have come on the rise. In the past, when you've seen the downgrades on the rise, usually immediately following that, you've seen default rates, follow. Now, I've seen some analysts suspect that probably by year end we might see 10% in default rates. So that's why the Feds are going out and they're buying these bonds, because what's happening because of these downgrades and these default rates is banks are tightening their credit. And when they start to tighten credit, that doesn't allow for the free flow of money out there to help these companies survive through this. So in a way, what's happening is the Feds are bypassing the banks and directly funding these companies directly by buying their corporate bonds. So just in the past, we've had historically only 4 times where the default rate has been above 10%, and every time you can see here by this chart, it averaged about 12%, and the economic or the decline in the stock market averaged 53%. So we'll see where this one ends up. Look at all this money that the Feds are throwing at this economy. You know that orange line is a cumulative growth in the S&P 500. Okay, looks real good when you go back to the last recession. But look at that. That purple line is a cumulative real GDP growth, and that blue line is the cumulative revenue growth. So all this money that they printed this, through the last, 10, 11 years to keep us in, keep us in recovery, throwing a lot of money at it and not really getting a lot of bang for our buck when you look at this. Wages, we're hovering around 4 or 5% year after year, and now just took a huge drop. Now looks like it might be on the uptick. We'll see where that's going. Crude oil. Literally, you can see it dropped like a rock there in April when it got to the end. Oil is supply and demand driven, right? So you have that, but you also have speculators in the futures market. And what happened is it was coming end of April, these people that were in it for speculative reasons, right, were being told that they were going to have oil delivered and they didn't want oil, right? Because usually they could sell these contracts before the end of the month and get off because they don't want the oil. They're just tracking the prices of them. So they were basically paying people to not have to receive the oil, if that makes any sense. And it literally drove the price down into negative territory. A roll of toilet paper was worth more than a barrel of oil at that time, if that makes any sense. Now, I think the speculators have jumped out of the market accordingly, because we didn't see that happen in May and we didn't see that happen again in June. But what's sad is it's still only hovering around $39 a barrel. My understanding of most of these oil companies, they can't make money at that level. They need to see $50, $60 or more before they're making money. I think as of the airing of this show, Chesapeake Energy just basically filed bankruptcy now too. So I think that sector is getting really hit hard. They were, especially those that were highly leveraged. They're not going to survive this. CRB Commodity Index. This is just a basket of 19 commodities that it tracks. In April of 2016, it had taken a historic low, but through this pandemic, even dropped now below that. Again, another little uptick on the good side. We'll see where that's going. U.S. dollar, basically this is just tracking our currency with all the other major currencies. And since 1973, they based that line at 100. And then ever since, we've just been tracking it from there. As of the end of June, it was at 97. What's that say? It says our currency relative to all the other major currencies is about what it was in 1973. Now, a strong dollar, it seems like it should be a good thing. We want to see it strong, but it does hurt us from an export standpoint because it makes our exports a little more costly. That's why you see these companies play around with their currencies, because if they can get it down, it makes their exports more cheap. It makes it more cheap. U.S. consumer confidence was at great levels pre-pandemic, dropped like a rock with everything that's going on. As of recent, starting to head up on the upside. So we'll see again where that's going. Small business sentiment. This has been tracked since 1986. It also was at great highs pre-pandemic, and now is dropping. This is a place I want to really see. We hear a lot about corporations and what's going on with them. What I'm waiting to see is how did small business fare through this? I'm already hearing these in our own area. A lot of them that didn't open up, can open up, and there's all kinds of jobs behind all those small businesses too. So we'll see where that goes, but I dare say that the economic damage might be greater than we may have realized. U.S. manufacturing, when it's above 50, you can see it's in expansion mode. When it's below 50, it's in contraction. Dropped like a rock with this pandemic. Has since come back. It's right at 50. So hard to say, we're kind of on the borderline of expansion, contraction as far as manufacturing goes right now. Non-manufacturing dropped like a rock with the pandemic, been a slight uptick, but is still in contraction mode at the present time. S&P 500 PE ratios, this is just the stock market divided by its earnings. Historically, the market is traded at about 17 times its earnings. If it gets above that, you're typically getting into frothy territory or overvaluation territory. It's been around 22, and a lot of people justify that with the low interest rates. Maybe it can, justify a higher PE ratio. Right now, it's at about 22. It's not necessarily an overvaluation territory, but you have to understand this PE ratio is looking back at the earnings over the last 1 year. what does that look like if you're going to go forward with earnings? Where would it be? So, and some of that evidence is not out yet. So we'll see where this goes. Right, just looking back, we're not necessarily in a frothy area right now or overvaluation territory, but right on the borderline. U.S. corporate profits, you can see over the last 10 years, were steadily on the rise, which gave us great justification for why the market was rising as well. But with this pandemic is now starting to take a big drop. And if you look at the U.S. corporate forecast by the Feds, it looks like it's definitely trending downward. We just have to find out how much downward it's going to be. I think my fear is that when we're at the top of the valuations and earnings are heading down, what are we going to have to drive this up, at least from this point? Huge disconnect between what's happening in the markets and the earnings. You can see here in the orange, that's the S&P 500 profit margin, dropped quite considerably. But in the blue, that's the S&P, that's the market going up. So this is not a very fun market rally we've seen since that March low, because the fundamentals, there's so much uncertainty and the fundamentals are not good. Earnings are going down, and yet the market is going up. This is just the VIX rate, or what we call the volatility index. Some call it the fear gauge. It usually hovers around 20. Now, a VIX of 20 means they expect over the next 30 days the market to be 20% to the good or 20% to the bad. It basically just says how wide the range of returns could be. You can see with the pandemic, it got as high as 80. All right. As since has been coming down, it's now settling around 35 at the end of June. That's getting better. So we'll see where the volatility goes. But for the most part, it's above its averages right now. This is crazy. I've heard more people talk about this. How fast the market is moving day to day as far as volatility goes. You can look at this. Anytime the market, if you look at the number of years here, it's going back to like 2013. This is showing the percent of time that the market went above 1% or below 1% in one day. And you can see here, year to date for this year, 55% of those days, better than half the time, it rose by more than 1% or lowered by more 1% in a given day. So much volatility happening. These are the treasury rates. You can see 3-month is just under 0.2, basically 0.2%, but a 30-year treasury right now is only paying around 1.41%. That is just crazy. That means I want to give the government my money for 30 years to make basically 1.5%. There's 3 stages in a bear market. You've got the first stage, that's that panic selling. I dare say we saw that 2 weeks in March where it dropped to 34% in just a 16-day period. And then I said we'd enter a second stage, which is that, people buying the dip, selling profits, buying the dip. And you've seen this go back and forth, but for the most part, trending upward through this. You don't typically get to the end of a bear market till you get to that place where it just feels like it's never going to come back. People are buying the dip, taking profits, and it gets volatile. But when it starts to kind of move down and people get a little bit discouraged, what happens is you get to that very bottom, and it's despair. When you get to that stage in a bear market, that's you want to look, because that's typically a good time to get in. I found this interesting. This is that chart when you're in the hospital, the nurse gives you when it wants to give you a number as to, how you're feeling, right? Because this is going to determine how much meds they're going to give you, right? And so I dare say when we're at despair, it's probably number 10, right? That's the time. But where are we right now? You got a lot of analysts believe things are heading more up. Some believe down. I'd say we're probably 4 or 6, right? Depending on who you are, but somewhere right in the middle. Wall Street is never been more confused about which direction it's going. You can see that you look back historically all the way to 99. The standard deviation between what analysts believe this is going to go is so wide right now. Now, the average analysts believe that if you take that average of all those analysts, they believe we're going to be about, in the S&P 500, it's going to be about 3,098 or 3,100 by year end. But the range of where everybody else thinks on the up and down is just crazy. So again, there's just so much uncertainty out there. Nobody knows where things are going. And of course, game changers could be a treatment or a vaccine come out sooner than later. So, what are all these major concerns? You've got the pandemic recovery. How quick are we going to recover? Will we get that treatment? Will we get that vaccine? Will there be a second wave? So many things wrapped around just that. Bankruptcies, as I talked about earlier, how many are going to be able to weather the storm through this? And if banks do really tighten up credit, what's that look like? Unemployment. How many of all these jobs that, people, when they file for unemployment, how many of these jobs are going to be there when they come back? I saw a recent study come out of the University of Chicago, and but they said 41% of those jobs won't be back. So, but where's that going to end up? Social unrest. We're seeing rioting in all these cities. And some of it I totally understand, but there's a lot more that goes behind a lot of what we're seeing happening right now in that social unrest. It's an election year. So many people ask you, Larry, what do you think's going to happen if, Trump wins again? Or what if Biden wins? What's going to, I always say this, and it's so true. Half the people are going to be happy, half are going to think the world's going to hell in a handbasket, and so it's going to be a lot of emotions, but most typically, running up to an election, can be some volatility in the market. After, usually it's short-lived because people realize that the world's not going to fall apart because their party didn't end up in control. But and then the other thing that's growing right now and is causing a lot of uncertainty is this nationalism. It starts to restrict the free trade, across the world, and I don't quite know how that's going to affect things. But most economies need to be able to import and export, and they want to be able to export what they have a large quantity of and import what they don't. And there's a balance there that has to be struck globally. But now you got countries talking too much lately. It seems like just protecting themselves. They're holding back, exports and I just, with this disruption in supply chains, it's just hard to say how that's going to have an effect on things as well. So this is out of Accounting Today, talking to CPAs. Better than half think the pandemic's going to be over by the end of the year, as you can see. And then you've got better than half, though, that don't think the economy is going to come back until after the first quarter of next year. So that's just what they're thinking. Travel is now on the rise again, but at this point, it's still only 20% of what it was at pre-pandemic levels. So I dare say this is going to be an industry that's going to be a long time in recovering because how quickly are people going to be safe again to travel like they were before? New COVID cases, since this whole pandemic started, has been on the rise. A lot of people equate this to all the, increased testing now that's being done. But new cases, you can see trending upward. But this is a good sign. The death rate has been on a decline. And certainly if we get any kind of a treatment or anything that can, help in the recovery process, we might even see this go down even further. And then if you look at this with pandemic, it's been regional. You look at the Northeast and Midwest, they've been on the downtick as far as new cases go. But South and West definitely been on the uptick. Now, these were a lot of states that opened up early. I think the jury's still out as to whether they should have done that or not. We'll see. I talked about the social unrest here a little bit and the rioting that's happening. Before the pandemic struck, 40% of Americans were basically living paycheck to paycheck. So it's no wonder the feds are throwing all kinds of money at this because they know there's going to be major social unrest if a lot of these people start to lose their jobs and can't get by. But what I say goes a lot behind this, and I think this has been building up for quite some time, is just the economic inequality that we have between a lot of the races. You can see as far as income, the whites compared to blacks and the Hispanics, and then even more so when it comes to net worth. So a lot of this, I think, the social unrest is more economic driven. You've had, the top 10% economically do even better exponentially, and then the bottom 90% not doing as well, and certainly those at the lower level. And I think that's why we're seeing a lot of what we're seeing today. This equate that with this as well. The purchasing power of the dollar, you can see since 1970 has been, hitting all-time lows right now. So, I used to, I've told people this when I was younger. I got out of high school. I put myself through college with minimum wage jobs, and I could support myself and go to school at the time. My kids today, they couldn't do that. They certainly had to have their parents' help. They can't make a living right now on part-time jobs. So things have changed. Purchasing power is definitely depleted. Election, again, depends on what side of the fence you're on, as to whether it's going to be good or bad. How it's economically going to have an impact. There's going to be some volatility associated with it, because again, you got half the people, if half think their candidate's not going to make it, they're depressed. The other half, are happy, and vice versa. So, where that's going to go, but understand that the biggest thing that affects economics is policy. And, running up to the election, we're not going to have a whole lot of policy changes. And so right now, we can't say the election's going to have a real big impact on the economy. Once there's some policies established, maybe, but we'll see when those come. So what's our roadmap? We're still continuing to take a defensive posture. With where the markets are right now, they may not be in overvaluation territory, but I dare say with all the concerns out there and earnings on the down, what's there to drive this up further other than more speculation, which I wouldn't want to chase after. We want to look for that final stage in the bull market. When it's pulled back and corrected, and you literally get to that place where people just don't believe it's ever going to come back, that's going to be a great time to enter back in. And good news on the pandemic front. We're much farther along now in this. We know much more about this disease. And so, I dare say we get that pullback in the market with what we know now and where we're at. I think it's going to be a good time to dial up a little bit more equity exposure and take advantage of that on the other end. With these low mortgage rates and low oil prices and interest rates at historic lows, and all this money that the Feds have pumped in the economy, I think that's just going to be all great fuel to have another great recovery, and you're going to want to be part of it. Just a couple bright lights. Always try to make a case for gold in these kind of times. Although we might want to take a defensive posture, we tend to be very bullish on gold. Gold, if you see these past times when the market has dropped, had a drawdown of more than 15%, gold has performed very well. It's a great hedge in recessionary times. So certainly would not put all your eggs in one basket, but having 5-10% exposure in that is something that would be very warranted. Real estate, another bright light. This is not 2008. You can see the supply in housing is at 6 months. Housing is much more supply and demand driven, and the supply is basically a historic average of about 6 months. So that's good. But there's been such a downside to housing starts. So, as demand for housing is on the rise and there's no supply, I dare say it creates upward pressure in prices. We're already seeing that in our own area. The sales are down, but the price of the houses is actually on the up. Couple that with tremendously low interest rates, so I don't think you're going to see housing be a big issue. It's if anything, it's probably a good asset to be holding right now. So with that, thanks for joining me. Talk to you soon.